COVID-19, did you find accounting complex for your small business? And now that you've received funding from CARES Act loans or even grants, it's complicated your accounting? Join the club. This workshop is going to break down some of the various accounting methods for grants and loans and how they impact your bottom line and financial reporting. The seminar is going to include discussions about how to account for funds received as well as how you use those funds that you receive from both grants and loans. I'm Shanice Bennett, CPA with AccuTrack Consulting and Accounting Services, a Michigan licensed CPA firm. For the last 11 years, we have provided accounting and financial management solutions and training to over 750 businesses. Today, I'm going to share some tips with you on accounting for grants and loans. First, let's talk about accounting for grants for your small business. And one thing to keep in mind is that your business has to apply consistently your existing accounting policies and principles for recording transactions. In other words, how you record grants right now or prior to COVID-19, you want to adhere to those same rules as long as they are compliant with government and accounting guidelines. So, let's talk about grants first. How you actually record the grant in your financial records really depends on the conditions of the grant. There are three primary conditions. Is this going to be a reimbursement of expenses that you've already paid? Is this going to be an advance for qualifying expenses that can be used for the grant? Or is it a subsidy to replace your income or to be used as you choose? If the grant is subject to multiple requirements, you should carefully assess how you track and account for it. You don't want to make the mistake of using grant dollars to cover the same expenses if the grant does not allow that. So one option for recording for a grant, if it's a reimbursement, is we recommend that you record the grant as other income on your income statement. Give it a completely separate line. If you receive multiple grants, you can also have sub-accounts under grant income, where you track the amount of the grant funds received for each individual grant. Be mindful of the requirements for the grant. Some of the requirements state that you cannot use the grant dollars to cover expenses that are either reimbursed or covered by another grant, PPP loan, or sometimes CARES Act funding from other sources. Another option, if you are receiving a grant in advance to offset some of your expenses, you may be able to record the grant income as deferred income, which is a liability on your balance sheet. Deferred income says you've received the money, but you have not met the requirements of the money just yet. If you choose the deferred income method, whenever you do spend money on qualified expenses, you can then remove the amount spent out of deferred income into that grant other income category. Make sure you also choose to record other grants in the same format. You want to be consistent. You may also choose to record other grants as income initially, but be mindful of those requirements that grant dollars are not used for the same expenses. Finally, if you receive a grant as a subsidy, such as a replacement of income lost, or you have the flexibility to utilize the grant funds as you see fit, you can also record that as grant other income on your income statement. If your business received a loan, such as the SBA EIDL loan or a loan from your grant or some other agency to help your business carry on through this COVID crisis, that loan should be recorded like any other typical loan. You would have to adhere to generally accepted accounting principles or your original accounting policies for recording a loan as a debt or a liability on your financial statements. You also must accrue the interest on that loan. For example, if you receive the EIDL loan, the total dollar amount that was dispersed should accrue interest at a 3.75% annual rate from the date of the loan disbursement. One way to help you calculate the interest to be accrued is to create an amortization schedule. You can work with your accountant or maybe even download templates online to create the amortization schedule. It will itemize the portion of your loan balance separately from the interest, and you can record or accrue the interest in your financial statements on a regular basis. And that amortization schedule will definitely come in hand when you start to repay the loan. If your business received a loan that is potentially forgiven, it's important to note that there is no specific guidance on how you must account for a forgivable loan. What we recommend you do is have a conversation with your accountant, or look at how you've previously accounted for loans or other transactions that are similar to a forgivable loan. You could also consult with and look at some of the literature and guidance from the Financial Accounting Standards Board. And based on the information you receive or learn there, that is how you should record your forgivable loan. If you're unable to find that information, or maybe you don't have an accountant, we have a few options for you too. The first option, if you are fairly certain that the full amount of your loan, such as the PPP loan, is going to be forgiven, you can record that loan as deferred income. Deferred income is a liability that shows up on your balance sheet. It's kind of like receiving a retainer or a deposit from a customer, and you haven't given the customer the product or service yet, so you owe this service or product to the customer. There's no interest on it. So as you complete the product or service and deliver the product or service, you reduce the amount of that deferred loan. The same is true for forgivable loans such as PPP. Remember, the loan was supposed to be used on payroll and other qualified expenses. As you make payment on those other qualified expenses and payroll, you can then reduce the amount of the deferred income. The second option that we recommend is, if you're fairly certain that the loan will be forgiven, to just treat it like a grant and record it as other grant income. Just like grants, we strongly recommend that you have a separate sub-account for the PPP loan and call it PPP grant. Again, if you are fairly certain that 100% of the loan is going to be forgiven, initially record it as other income, a PPP loan grant. Finally, if there is a possibility that the loan will not be fully forgiven, we strongly recommend that you account for the PPP loan as a debt, very similar to that of the EIDL loan or any other loan you receive. You'll have a separate sub-account to show the proceeds from the PPP loan. Since there's no interest incurred initially on the loan, you don't have to worry about an accrual. However, once the loan application has been approved or denied, then you'll properly account for interest. Once again, the three options for accounting for a forgivable loan is to record the loan proceeds as deferred income. Or if you're fairly certain that the loan will be forgiven, 100% of it will be forgiven, you can record the proceeds from the loan as other income. Make sure that under either of those circumstances where you're fairly certain that the loan will be forgiven, if you record it as other income, you have a separate account for PPP loan, or if you record it as deferred income, there's a separate liability account for deferred income. And the final option is, if you are not certain that your loan will be 100% forgiven, to record the loan as a debt or liability. When it comes to tracking the expenses that are paid by using either the loan or grant proceeds, there are several ways to do it. Some folks prefer to take those proceeds from the grant or from the loan and open up a second bank account. That second bank account will then be used to make payments for the qualified expenses. So for example, you receive a PPP loan of $100,000. You create a sub-account or separate bank account when you receive the $100,000, and you use that account to make payments for payroll. So having a separate bank account and then paying only qualified expenses out of that account is one way to track your expenses. Now, it may not have been very easy for many of you to get to a bank and open up a second bank account. So what some small businesses have opted to do in their financial or accounting records is create a separate bank account in their accounting records, where they deposit or show a deposit or make a journal entry to transfer the monies into this separate sub account that's specifically from the grant or specifically from the loan. And then the same thing, whenever a payment is made on any qualified expenses, it is paid out of that sub account on the financial or accounting records. Again, it doesn't require that you have a separate account. It's just a separate sub account in your financial records that's going to allow you to track how you use those dollars. Another less sophisticated way for some small businesses to track the expenses that were paid with the grant or loan fundings is to create a spreadsheet. On that spreadsheet, you will list out all the qualified categories that that fund or that loan can be used for. Categories typically are payroll, business mortgage interest, rent or lease, or utility payments. So you have a spreadsheet that lists all of these different categories that the funds can be used for. And every time that you make a payment towards any of those qualified funds, you update the spreadsheet. On that spreadsheet, you're going to include the date of the payment for the qualified funds. You're going to include the amount. You're also going to include the source of the payment, which bank account you use. And it's going to be important to identify which source of grant or loan funds that were used. Remember, many grants and CARES Act funding requires that you cannot use the funds towards the same expenses. So on this spreadsheet, if you're going to identify an expense paid from the PPP loan, that will be an easy way to make sure that you do not double dip by paying or accounting for the same expense from multiple sources of grants or even loans. The other thing that you may want to consider if you do not have an accounting system is the documentation that's going to be required. Now here's the catch. No matter how good you track or not track your expenses, you are going to be required to sustain the documentation to support any expenses that were used for grant funds or from CARES Act loans such as the PPP or EIDL. That documentation could include things like your payroll reports, bank statements, canceled checks, and credit cards. You may not necessarily have all of that information in an Excel spreadsheet, but you should have it in your accounting records. And although you don't have the images in the accounting records, you may be required to submit those images and documentations to your lender, or in the event that you are audited and asked to submit proof of how you use the funds. So keep in mind that when it comes to tracking the expenses that you paid from funds that were received from either grants or even CARES Act loans, it is critical that you track those expenses by date, by amount, and keep track of which funding source, which grant, which loan was used to cover that expense that was paid. A few final thoughts as it relates to loan forgiveness. After your application for loan forgiveness has been formally approved, it's important that you remove that debt from your financial statements. And you'll do that by reducing the debt by the amount of the forgiveness and increasing other income, which will be considered a gain. The other thing I would like to leave with you is that we do not recommend that you reduce the expenses that you've paid with CARES Act funding, whether it be paid from a grant, from the PPP loan, or any other CARES Act source of funding. We recommend that you account for those funds either in those deferred liability accounts, sub accounts for the bank account, or accounting for it on your income statement as other income. What you do not want to do is to reduce the expenses that were paid, because keep in mind, when you apply for loan forgiveness, you are required to report what your total expenses were for payroll. You don't want to reduce that payroll amount by your grant amount and then not report your total expenses. So keep in mind that once your loan approval or your loan forgiveness is approved, you want to reduce the debt and record that approval as a gain on your income statement. And you also want to keep track of the actual expenses paid by not reducing those expenses by any grant or loan funds received. Thank you so much for joining me. I'm Shanice Bennett with AccuTrack Consulting and Accounting Services.